Welcome to StockStream's Investor Education Series. This presentation is brought to you by StockStream Financial Services in collaboration with MyStockStream.com. Today, we will look at the basics of technical analysis. Trading inherently is risky and may not be suitable for all investors. Therefore, we recommend that you treat the contents of this presentation strictly as educational and informational in nature. Our goal at StockStream Education is to increase the awareness level of investors. We propose that you learn concepts of analysis using StockStream's education's training material. Then, follow StockStream experts at MyStockStream.com to see the techniques you have learned being applied to live markets. Once you are more comfortable with a particular technique, we recommend that you conduct your own analysis, get it reviewed by a StockStream expert, and then put it to trade in live markets. Technical analysis looks at chart patterns to identify trade setups. It is based on the assumption that all current market information is reflected in live prices. Technical analysis is not an exact science. Therefore, you cannot rely on an indicator to give you the same results even in similar market conditions. The steps to conducting technical analysis are as follows. Identify the market bias. The market may be in one of the following directions: an uptrend, a downtrend, or a range trade. Determine your trading strategy based on the market bias, and then use one or more of technical indicators to determine the entry points, including trend lines, moving averages, Fibonacci analysis, oscillators, or Bollinger Bands. A market is said to be in an uptrend if it is making a series of higher lows and higher highs. We should be looking for buying opportunities close to support levels in an uptrend. One or more technical indicators can be used to identify support levels that can be used to enter long trades in an uptrend. A market is said to be in a downtrend if it is making a series of lower lows and lower highs. We should be looking for selling opportunities in a downtrend. One or more technical indicators can be used to identify resistance levels that can be used to enter short trades in a downtrend. Markets that are not in an uptrend or a downtrend are said to be trading in a range. Markets trading in a range are said to be in consolidation. Markets generally consolidate either after an up move or down move. Markets generally spend more time in a range than in an uptrend or a downtrend. If you see markets trading in a range, you should be looking for buying opportunities near supports and selling opportunities near resistance levels. Once you determine the market bias and the type of trade you are going to take, the last step involves using one or more technical indicators to determine a trading strategy. A trading strategy basically gives you three price levels: a price to enter the trade, called the entry level; price to exit the trade if it goes against you, called the stop loss level. A stop loss is the level at which the trade setup given by the technical indicator is no longer valid. The third level is the price to book profits, called the limit. Trend lines are one of the simplest technical indicators used by analysts. A trend line is a straight line connecting consecutive higher lows in an uptrend and consecutive lower highs in a downtrend. A test of the trend line offers buying opportunities in an uptrend and selling opportunities in a downtrend. Trend lines are easy to use and are closely watched by a number of technical analysts and thus provide very good entry levels for trades. Now, let us look at an example to demonstrate the use of trend lines. The first step before entering a trade is to determine the market bias. By looking at the chart here, we can clearly see that the currency pair is making a series of higher lows. Thus, the pair is in an uptrend. We should be looking at buying opportunities. The last step involves using trend lines to determine a trading strategy. This trading strategy should give us an entry, stop, and limit. Once the market bias is determined, draw a trend line by 2 consecutive higher lows. You should be looking to buy a confirmation of a bounce after a retest of the trend line. Confirmation can be established by using candlestick patterns or other technical indicators like RSI, stochastic, etc. Stops on the trade should be placed below the lows formed after a test of the trend line. You should be looking to exit the trade on a break below the trend line. In this example, we enter a long trade on the formation of a candlestick reversal pattern after a test of the trend line with stops below the lows. Let's look at another example. In this case, the market bias is clearly lower, as indicated by the formation of a series of lower highs. Thus, we should be looking for selling opportunities. We will use trend lines to identify a trading strategy. Once the market bias has been determined, we draw a trend line connecting 2 consecutive lower highs. We will be looking to sell on failure after a retest of the trend line. A failure can be confirmed by looking at candlestick patterns or other technical indicators. We put the stops on the highs formed before the failure at the trend line and look to book profits on a break above the trend line. In this example, we sell after a reversal candlestick pattern is formed after a test of the trend line and place stops above the highs of the reversal pattern. Psychological levels are price levels that are considered important by traders. These are generally round numbers that are easy to remember, like 50, 100, etc. The rationale behind these levels as being important is that a number of traders place stops or limits near these levels because they are easy to remember. Thus, psychological levels act as support or resistance depending on the market bias. Again, the first step before entering a trade is to determine the market bias. In this case, we see that the market is in a downtrend, which is evident by the formation of a series of lower highs and lower lows. We will be looking for selling opportunities in this market. We will use psychological levels to enter trades on the short side. We will sell on confirmation of failure at a psychological level with stops placed above the highs formed before the reversal. We will look to book profits on a test of another psychological level or reversal signals generated by other technical indicators. In this example, we sell failures at psychological levels of 1.8, 1.7, and 1.6, with stops placed above the highs of the reversal candle. RSI stands for Relative Strength Indicator and is a technical indicator that is used to determine the market momentum. This indicator can only take up values between 0 to 100 and thus falls under the category of an oscillator. RSI values between 70 to 100 indicate overbought conditions, and between 0 to 30 indicate oversold conditions. Markets can remain in overbought or oversold conditions for extended periods of time, so you should not buy a pair just because it is oversold or sell it just because it is overbought. The trading strategy for this indicator involves selling the market if it moves and closes back below overbought conditions, and vice versa. Let's look at an example. The first step when trading using the RSI is to determine the market bias. We can see from the chart on the right-hand side that the market is making a series of lower highs and lower lows. It is therefore in a downtrend, and we should be looking for selling opportunities. We will use a RSI to determine a selling strategy. Note that we used a daily chart to determine the market bias, and we will be using a 4-hour chart to execute the trade. The rationale behind this will be covered in more detail in the multiple timeframes training session. We initiate a short trade when the RSI closes below 70 after being in the oversold region for some time. The stops for the trades can be placed above the high, formed before the reversal, and the position can be held until we touch the oversold region or some other indicator gives a reversal signal. If you have any questions, visit mystockstream.com and contact us at StockStream Education. You can also contact any of our other experts covering Forex, commodity, or equity markets. We will be more than happy to answer any of your investment-related queries. Thanks for listening to this presentation, and have a great day.